Bye guys. So in this particular session, what we'll be discussing about is fill. Okay, so it's question number 23 from section B's question SPR's exam kit. So I'll just read out the requirement first of all, and then we will uh, solve it in its own order. Okay. So advise the directives of fill how the above transaction should be dealt with in its financial statements with reference to relevant IFRS standards and conceptual framework. The split of the mark allocation is shown against each of the three issues above. Okay, so 7 marks for A, right? So what do we need to talk about in A is Phil is a coal mining company and sells its coal on the spot and future markets, right? On spot and futures market. The spot market commodity is traded for immediate delivery, and on the forward market, the commodity is traded for future delivery. The inventory is divided into different grades of coal. One of the categories included in inventories at 30th November 20x6 is coal with a low carbon content, which is of a low quality. Okay, with a low carbon content is a low quality. Phil will not process this low quality coal until all of the other coal has been extracted from the mine, which is likely to be in 3 years' time. Okay, so it's not will not process this low quality until all of the other coal have been extracted from the mine, which is likely to be in 3 years' time. After 3 years' time, okay. So based on the market information, Phil has current calculated the 3-year forecast price of coal will be 20% lower than the current spot price. The directors of Phil would like advice on two matters: whether the conceptual frameworks affect the valuation of inventories, how to calculate the net realizable value of the coal inventory, including the low quality coal, right? Okay, so first of all, let's talk about whether the conceptual framework affects the valuation of inventory. Conceptual framework, right? The conceptual framework acknowledges two measurement basis, which is historical cost and current value. Right. And current value, right? So net realizable value NRV is a current value measurement however conceptual framework is not an accounting standard, and so in order to determine NRV, the directors should refer to IAS2 inventories. Okay. And the second thing is regarding that, right? Regarding NRV, net realizable value. So how does IAS2 define net realizable value? Is IAS2 defines NRV as the estimated selling price in the ordinary course of business. Estimated selling price in the ordinary course of business less the cost of completion and costs of sale, right? In this case, NRV will be determined on the basis of conditions which existed at the date of the statement of financial position. Okay, so the condition exists while preparing the financial position, that will determine the NRV. Okay, financial position, right? NRV will be based upon most reliable estimate of the amounts which will be realized for the cost. Based on most reliable estimate, right? This talks about year-end spot rate, right? It talks about spot rate is a coal mining spot and future market. Okay, so let's talk about spot rate. The year-end spot rate will provide good evidence of the net realizable value of inventories, value of coal, right? And where the company has an executory contract to sell at a future date. At a future date, just write inventory as well. Okay. How do I change it? I have to click on it. Okay. In case of future, when there is an executory contract, what should we do? Then the use of the forward contract, forward price may be appropriate. Okay, so if it is for selling at the spot price will be a good evidence, whereas if it is for selling in the future at a future date, then that might be appropriate, right? However, if the contract is not executory but is a financial instrument under IFRS 9, financial instrument or an onerous contract recognized as a provision under IAS 37 provisions. When do we create for our provisions is when we have a present obligation is or obligating due to result of obligating event. Okay, so when it is highly probable that the payment is likely. Okay, so that will need to be into consideration. Contingent liabilities and contingent assets. So when do we recognize the provision in case of contingent liability is when it is virtually certain, when it is probable, when it is possible. What do? We just disclose contingent liability, right? And in case of assets, we recognize when it is only virtually certain, and the when it is probable, we just recognize it as a contingent assets. Okay, but that was in the older case. Now since the probability criteria has been removed, so even though if the probability is less, if it provides reliable and faithful information, we still recognize it. Okay, it is unlikely to be used to calculate NRV. Okay, if it is non-executory contract under IFRS 9, then it is very unlikely. Should be comma. So what should Phil should do? Phil should calculate the NRV of the low carbon content, low carbon coal using the forecast market price based upon when the inventory is expected to be processed and realized future changes. So when it will be realized, right? When it will be processed and when it will be realized, it should do based upon that. Future changes in the forecast market price for the processing and sale of the low carbon coal may result in adjustment, right? Because that may change every year. NRV has these adjustments are changes in estimates what will we do in case of changes in estimates? We will have to use as per IAS 8, right? IAS 8, let's give them that. Accounting policies, changes in accounting estimates and errors, right? This will apply with the result that gain or losses will be recognized in SOPL in the period that they arise. Okay, what would happen? And then the next question basically tells us at 30th November 2006, the directors of Phil estimate that a piece of mining equipment needs to be reconditioned every 2 years, right? They estimate that this cost will amount to 2 million for parts and 1 million for the labor cost of their own employees. So at 30th November 2006, the directors of Phil estimate that the piece of mining equipment needs to be reconditioned every 2 years. They estimate that the cost will amount to 2 million for the parts, 1 million for the labor cost of their own employees. The directors are proposing to create a provision for the next conditioning which is due in 2 years' time in 20 exit along with essential maintenance cost. There is no legal obligation to maintain the mining equipment. As explained above, it is expected that there will be future reductions in the selling price of coal which will affect the forward contracts being signed over the next 2 years by Phil. Require advice on how to treat the reconditioning cost and whether the decline in price of coal is an impairment indicator. So what could be this? This could be an internal indicator, isn't it? As per IAS 36. So first thing first, replacement costs. So PP 16, right? The plant and equipment. Plant and equipment. Why am I writing PP over here? Should be IAS. Right? Requires an NPP to recognize in the carrying amount, right? Carrying amount E, the cost of replacing part of such an item. When each major inspection is performed, the cost recognized in the carrying amount is derecognized first of all. The cost is recognized. If it is a separate component, what we do, we basically uh, remove that, derecognize that particular asset, and then we recognize the other one. Okay, the cost is recognized in the carrying amount of the item. Okay, very important thing, of the item. It is a component. Okay, item of PPE has a replacement if the recognition criteria are met, right? Any remaining carrying amount of the previous inspection is derecognized. The costs of performing a major reconditioning are capitalized if it gives access to future economic benefits, right? Otherwise, there is no point of doing it. So, cost will include labor and material cost, which is how much over here? 2 plus 1, 3 million, right? So, which is that is of performing the reconditioning right? However, costs which do not relate to the replacement of component or installation of new assets, such as maintenance cost, not only that, routine maintenance costs should be expensed as incurred, right? So next thing we need to talk about is provision. So let's write about provision as well. As per IAS 37, create provision, there should be present obligation which could be legal or constructive. Constructive, both, okay. This should be there. Since in case of, what is the name of the company again? Phil. In case of Phil, there is no legal or constructive obligation to undertake the reconditioning no constructive obligation to undertake the reconditioning so provision is not required rather the costs of the reconditioning should be identified as separate component and depreciated. Separate component should be identified as separate component of the mine assets at initial recognition and depreciated over 2-year period, right? This will result in same amount of expense being recognized as the proposal to create a provision, right? Because we are creating a provision for 2 years, so we do that same thing, and then in this case you will just be depreciating it over 2 years period, so the same amount of expense will be deducted, right? So next thing is, what do they talk about? They say whether it's impairment or not, right? The reconditioning cost and then decline in coal price, right? The future reduction in selling price of coal which will affect the forward contract being signed over the next 2 years period. Future reduction in selling price of coal. Okay. So impairment indicator. Impairment. IAS 36. impairment of assets says that at end of each reporting period, an entity is required to assess whether there is any indication that an asset may be impaired based upon what indicators? Based on external and internal indicators. If there is an indication, then the recoverable amount should be calculated and compared with its carrying amount should be calculated, right? Past and future, bold it. Past and future reduction in the selling price may indicate that the economic benefits which relate to the assets have been reduced, right? Mining assets should be tested for impairment whenever indicators of impairment exist. Impairment are recognized if the carrying amount is less than is more than its recoverable amount, right? That's when it is recognized. However, the nature of mining assets is that they have a long useful life. Commodity prices can be volatile, but downward price movement are more significant if they are likely to persist for longer period. Right? So what has happened in this case? In this case, there is evidence of decline in forward prices. If the decline in prices is for a significant proportion of the expected life of the mine, this is more likely to be an impairment indicator. Okay. Years, so it's of 2 years, right? That the future contract prices for 2 years out of the 3 years of the mine's okay, so out of the 3 years, 2 years, right? Remaining life indicate a reduction in selling price. Reduction in selling prices, okay? Based on market information, Phil has also calculated the 3-year forecast. Price of coal will be 20% lower than the current spot price, right? As the question is unclear whether the fluctuations is short term or long term, and the exact life of mine, what you could say is that therefore in the short term if it was short term then it's not impaired or vice versa. Impaired, whereas if it's long term then it's impaired. However, despite the difficulty in making such assessment, it would appear that the mining assets should be tested for impairment. Okay, so it should still be tested for impairment. So next thing is regarding control, right? Board control. So what we've been given is that Phil jointly controls coal mine with other entities. The Theta mine was purchased by 3 participants during the year. Sorry. Phil owns 40% and the 2 other participants own 35 and 25, right? So that is 60. The operating agreements require any major decisions to be approved by parties representing 72% of the interest in mine. The directors advise on whether the conceptual framework will affect the decision as whether the field controls the mine. The director is also wondering whether the acquisition of 40% would be considered a business combination under IFRS standards. Okay, so we need to give definition of control, right? So first of all, we need to give preference regarding conceptual framework as well. Conceptual framework states that an entity controls an economic resource if it has present ability to direct the use of the economic resource. Sorry. And obtain the economic benefits from it, right? From it. An entity has the ability to direct the use of an asset or use of an economic resource if it has the right to deploy the economic resource in its activities, right? In our own activities rather than somebody else's. Although control of an economic resource usually arises from legal rights if legal rights it can prevent it can also arise. So although control arises from legal rights, right, it can also arise if an entity has the present ability to prevent all other parties from directing the use and reaping its benefits. Okay, directing the use and reaping its benefit. You could say obtaining its benefit, whatever you would like. All right. For an entity to control the economic resource, the economic benefits from the resources must flow compulsory to the entity instead of another party. Okay, that is important, right? Although conceptual framework gives some guidance the definition of control existing IFRS standards should be used in making the assessment. Okay. So when do they have control as per IFRS 10? IFRS 10 consolidated financial statements states that an investor has control an investor defines control as power over the investee the investee is exposed or has rights to variable returns from the from its involvement with the investee. Next is the investor can use its power to affect the variable returns. All right. So that's one thing. And you can also define like power, what is power as well. Right. Phil does not have control whether if it's like it can have power like because the other shareholders are numerically dispersed and then or the agreement between different investors could be other factor, and then after that whether it can how much representation it has on the board, that will also be important. Whereas in this case Phil does not have control over the mine because its voting power is only 40%, which is insufficient for it to pass operating decisions that will affect the mine's relevant activities and thus its returns, right? Let's give them something else. However, in accordance with IFRS 11 joint arrangements would seem that joint control exists because the other two party because two parties share control and operating decisions require them to unanimously agree, right? The mine does not appear to be a separate entity, so is classified as a joint operation. If it was a separate entity, then it would be JV, okay, joint ventures. It requires only 72%, right? So what has happened is that basically the two parties, I'll just explain that as well properly, because the two parties, which is basically Phil and 35% holder, share control, right? So basically, like if these two parties agree 35 and 40, then they have a representation of 75, right? So if the operating requirement to make any major decision would be required, like if it was more than 75, then they would not even have a joint control. Rather, since they have more than 72%, which is 75, right, they have the voting power, so they have a joint control. That's what I'm just trying to say, okay? And then since the question has not explicitly mentioned whether it's a separate entity, so it is considered to be a joint operation, okay? And then after that, what we need to would be considered as business combination under IFRS standards, right? Business combination. Business combination. A business combination . IFRS 3 business combination as a transaction or other event in which an acquirer gains control. Okay, so what do they mean by other event? Is due to any other event. Suppose if the other shareholding has broken down, that kind of event might give a control to certain entity, right? Obtain controls of one or more business. Okay, the subsidiary could have another subsidiary as well, right? One or more businesses. A business is, what is business again? A business is further defined as integrated set of activities, integrated set of activities and assets capable of providing return. Okay, providing return. Thus, the mine represents a business. It represents a business. However, Phil does not have control. However, Phil does not have control, so it's not a business combination. Combination, okay. IFRS 3 states that the accounting treatment of the acquisition of an interest in a joint operation that meets the definition of business should apply same principles as are applied to a business combination unless those principles contradict IFRS 11. In other words, the identifiable net assets of the joint operation should be measured at their value However, unlike with a business combination, field should not recognize any non-controlling interest. Instead, field should not field should only recognize its share of mine's asset and liabilities, okay, even in SOFP. Goodwill would be recognized as the difference between price paid between consideration paid for the interest and Phil's share of net assets acquired, right? That's how it should be treated. Anything else? I don't think so. I think we've covered everything in this. Yep. Okay, so this is basically how we should answer this sort of questions. So the important thing that we have basically learned in this thing is that uh, it should, if it this thing is very important. Okay, IFRS states the accounting treatment of the acquisition of an interest in joint operation that meets the definition of business should apply the same principle as applied to business combination unless those principles contradict IFRS 11. Okay, so IFRS, the accounting treatment should not contradict IFRS 11. Okay, when you are treating for joint operation. Okay, so that's the new thing basically. Otherwise, everything else is pretty much the same, right? And then impairment provision is also there, and then provision is only when there is a present obligation, legal or contract constructive, right? Always need to remember that. So net realizable value is basically the estimated selling price in normal course of business, right? Isn't it? So any changes in the any adjustment to NRV is only a changes in estimate, so prospective, whereas in errors it is retrospective. In policies as well it is retrospective. Okay, so that's pretty much it, guys. So I'll see you in the next question, which will be question number 24, halls. Okay, so that should be again interesting one. It has management commentary and everything, so something new to talk about. So I'll see you in the next question. Bye bye.